Good morning, traders. Today we are going to dive into the FTSE 100 following yesterday's UK autumn budget announcement. After falling around 5% from record highs at 9950 to around the 4.2, 4.3 level, the index has bounced and is now setting up what looks like a textbook inverse head and shoulders continuation pattern. So let's break down the fundamentals driving this rally and then get into some of the technicals. Now, yesterday, Reeves unveiled the autumn budget for the UK finally, and she raised 24 billion pounds in taxes. Well, she pledged to. Um, through threshold freezes, a new mansion levy, and also higher dividend taxes. But here's the critical part. She committed to reducing government spending as a share of GDP every single year going forward. And why does this matter? Well, it matters because of government borrowing. The bond market, given of course the Liz Truss mini budget crisis as well a few years ago, was worried about fiscal deterioration. But Reeves did kind of showed discipline, right? She kept the fiscal headroom buffer at 22 billion pounds, up from 9 billion in the spring, and made it clear that spending will decline as a share of the economy. That's why gilts fell and the FTSE rallied, led by financials. Bond vigilantes backed off because the debt trajectory now looks sustainable. Now, of course, sterling also gained the best level, I guess, since October or so, above 132 towards 133, because lower borrowing risks and a stable fiscal outlook, of course, attract more foreign capital. So now, what's supporting sentiment going forward? The Bank of England is widely expected to cut rates in December by 25 basis points. Low rates are bullish for equities, but let's not, of course, ignore the headwinds. UK inflation is still sticky, well above the BO's target, and growth forecasts have also been downgraded by the OBR, given that we're going to have a tax increase. Now let's talk structure. The FTSE found support um, a week ago, down at 9.44 or so. Extended relief rally, pullback down at 9524, and then further extension, at 973. Next level probably would be around the 9.8. This is high activity level, but what we always want to do is to see if and where actually our own measured move projection takes us. If we assume that is like kind of the breakout level, I would say. So that also takes us close to 9.8. So this creates a very strong and quite magnetic structure for everybody to take into account, which essentially makes a good take profit if we are taking into account that someone enters a bullish position, a bullish bet. So also importantly, we need to see whether there is any confluence with the Fibonacci's, right? So this one comes above the 61.8, but below the 78.6. Critically, currently we are bouncing off the 50 Fibonacci at 9,690. Uh, but while being on the 4 hour, and we have kind of reached overbought, and that we see this correction now, whether this holds or not is a different question. Typically, when we reach overbought levels, we see a reset of momentum down to the 50 line. That might not be now, but it might also continue lower down now before we see further upside. So we have to be cautious on that. Okay. Now, for me, I am more interested to pull an opposite Fibonacci currently, okay, because we are supposedly expecting a pullback, perhaps, right? So down to 967. And so I want to see whether this aligns with any Fibonacci's, and it does. Perhaps the 13.2 would be a much better level, and a double bottom formation as well would be a bit more convicting, if that makes sense, right? And then we would be looking for prices to extend higher. The 23.6, it's some sort of aggressive entry, in my opinion. The 38.2, if confirmed with another rejection, it would be a more appropriate level to enter this potential pullback. The most aggressive, of course, entry would be to enter at the top or currently, because there is, of course, the short-term risks of just stopping at around the 9.8. That still gives some room to the upside, but equally the room to the downside um, is also quite open, if that makes sense. So for me, I would be looking to enter a long, and once again at 38.2. Uh, First target will be the 9.8, because essentially we are looking at revisiting previous highs, right? Entry at 38.2, um, stop at just below the previous low. This is a 2.1 risk reward ratio, above 2.1 to be fair. So it's already quite a good trade. If you wanted to be more aggressive and trade that pullback, you see you're essentially coming down at 1.2, pretty much 1/1 ratio, if you use the same stop. But if you were to trade that from higher levels, you would have to place your stop here. So you leave less space to the downside, if that makes sense. And we really, have to. We would prefer to see a reset first. Okay, that's primarily the point I'm trying to make here. So that would be a potential entry to the upside. Now, obviously, we are in markets, and markets move in opposite directions towards, you know, against our trades a lot of the times. The truth is that if we do lose this neckline, okay, and I would just go ahead and take this off and just pull like a support over here, which comes exactly the same level. If we lose the 38.2, then the risk of further upside downside is going to increase. That would eventually mean that our recent top, and it might happen after we see another leg up, right? It might just be a correction peak. This would open the door to 9,220, and we would essentially treat this as some sort of descending channel, some sort of consolidation to the downside that, of course, has different targets too. These shoulders would be very important as well at 9,530, the previous low at 9,440. Then we'll go at the previous low at 9,230, and then eventually the 900, 2020, which is a 100 Fibonacci extension. Okay, so bottom line, uh, traders, the FTSE is rallying because the budget solved the fiscal concern. Spending will decline and as a share of GDP, and government borrowing is under control. So adding the expected Bank of England rate cut in expected and in December, and you've got a kind of a supportive macro backdrop, right? Technically, the inverse head and shoulders is also supporting further upside towards the 9.8. This is like our line in the sun for pullbacks. Okay, targets, of course, above the 9.8 are the previous high. But remember, if we do drop below the 9,600 or so, okay, then it would eventually open, expose the inverse head and shoulders sort of um, shoulders, and would essentially open the door to lower territories. So I would manage, size around these inflection points, and blend always the macros with technicals for with any upcoming, of course, data from the UK, kind of, providing more context about what the next structure could be. Drop your setups in the comments and make sure to follow for more high action technical and macro trades.